Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
$400,000 for a single tractor. Yes, double the original price. And the reason? A tariff order from the White House. Before John Deere could even react, the market had already begun to shake. John Deere faces a 200% tariff. At a town hall in Pennsylvania, former President Donald Trump announced a 200% tariff on John Deere machinery imported from Mexico. That means a $200,000 tractor now costs $400,000, an increase that has dealers and farmers alike worried. John Deere responded immediately, stating it was conducting a comprehensive assessment of the new policy and potential countermeasures. Behind closed doors, engineers are crunching numbers because if they fail to adapt, who pays the price? Farmers, consumers, or the entire U.S. economy? What's more, the production lines in Mexico have been saving John Deere tens of millions of dollars each year. Relocating back to the U.S. would not only be costly, but also time-consuming. On top of that, nearly 40% of components in their best-selling models come from abroad, meaning the tariff doesn't just hit assembly lines, but could disrupt the entire supply chain. Impact on farmers and manufacturing. Immediately following the announcement, dealers reported a spike in orders within just a week. Farmers rushed to buy equipment before the tariff took effect. But behind the urgency lies a growing fear. If retroactive taxes are imposed, who will bear the massive cost difference? At agricultural fairs in Kansas and Iowa, the mood turned grim. "We're just watching. We haven't dared to sign anything," one farmer said. And the looming question, buy now to lock in prices or wait and risk doubling your costs. John Deere's strategic response. Facing this sudden blow, John Deere didn't retreat. It shifted into strategic mode, launching 3 major moves nearly simultaneously. First, the company accelerated reinvestment into plants in Iowa and Illinois, facilities previously scaled back due to high operating costs. Now, despite expensive domestic labor, Deere sees this as the only way to reduce dependence on cross-border supply chains, now a liability under tariff threats. Resuming U.S. production is not only an economic decision, but also a symbolic gesture to regain domestic market trust. Second, Deere ramped up lobbying in Washington, seeking tariff exemptions for key agricultural components like drive systems and smart control units. If successful, the company could maintain stable pricing without sacrificing quality or profit. But this is a long game, requiring political leverage. Failure could send ripple effects across the agricultural machinery sector. Third, Deere began restructuring its supply chain, shifting some production to Canada or other low-tariff countries. This is a global flexibility gamble aimed at avoiding being boxed in by an escalating trade war. Policy impacts and global reverberations. The impact doesn't stop at Deere. Other manufacturers, from Caterpillar to GM, are watching cautiously. Economists warn that if trade tensions persist, next quarter's GDP could shrink. Countries like Canada and Mexico have already responded. The EU and Japan are preparing cases to challenge the US at the WTO. In strategy rooms, analysts are modeling what-if scenarios. If the 200% tariff holds, production costs will balloon. If reduced to 50% on imported parts, companies might catch a breath. As May 15th approaches, pressure builds by the hour. Businesses await rulings, investors sit on cash, and those behind the tractor wheel, the farmers, may cast decisive votes in the upcoming election. Meanwhile, China watches from the sidelines, but not passively. Manufacturers in Shanghai and Guangdong are already expanding their lines, ready to absorb production flows leaving Mexico. Some experts warn if the U.S. overplays its internal tariffs, Beijing could be the biggest winner from this global repositioning. Will the administration ease off or tighten the screws? If this is a test of endurance, it's also a reminder, tariff decisions aren't just numbers. They shape the fate of entire industries.
China's economic system, with growth driven by manufacturing exports, will continue to create even more serious imbalances with its trading partners if the status quo is allowed to continue. China can start by moving its economy away from export overcapacity and towards supporting its own consumers and domestic demand.
On May 26, 2025, China ordered an increase in the proportion of trade transactions conducted in the renminbi from 25% to 40%. Did you know? This means that $6.1 trillion in global transactions are beginning to move away from the US dollar. This is truly a turning point that has shocked the entire world. D-Day, May 26, 2025, China changes the global rules. On May 26, 2025, what seemed like a small decision shocked the world. China ordered banks to raise the share of trade transactions conducted in renminbi from 25% to 40%. Can you imagine? $6.1 trillion in global transactions began shifting, elevating the renminbi to a new status, directly challenging the reign of the US dollar. But China isn't just changing numbers. They're building a new future focused on high technology, artificial intelligence, robotics, semiconductors, the key industries to lead the 21st century economy. Moreover, they're expanding production and domestic consumption, determined to price exports in renminbi, creating a self-reliant value chain no longer dependent on the US financial system. Imagine this: a nation not only wanting to be the world's factory, but also determined to become the master of global finance and technology. How will this reshape the economic game? Are you ready to explore this transformation with me? US tariffs backfire. How China is leveraging to surpass. Did you know that in the first quarter of 2025, the share of payments made in renminbi surged to 30%? This is no small figure. It reflects massive capital flowing into China, while demand for US bonds continues to decline. More notably, countries like South Africa, Iran, and Brazil are proactively using the renminbi to bypass US sanctions and restrictions. This signals a significant shift in the global financial landscape happening faster than we imagined. And what about the US tariffs, reaching up to 145%? Do you think they would slow China down? Far from it. Those sky-high tariffs have only accelerated China's exports, especially in heavy machinery. They cut product prices by up to 50% and cleverly signed contracts in renminbi to dodge tariffs, gaining a strong competitive edge internationally. Are you surprised? Are tariffs still the shield protecting the US economy like before? Or are they unintentionally pushing partners and markets into China's embrace? The new financial system, will the renminbi replace the US dollar? China is quietly building an interbank payment system called CIPS. Did you know? This system is increasingly trusted by many countries because it enables faster, cheaper transactions and, most importantly, reduces US control. But that's not all. China is expanding trials of a digital currency in special trade zones, enabling quick payments that are harder for Western financial authorities to monitor. This is a strategic move to build a parallel financial ecosystem nearly independent from the US-dominated traditional system. So, what are the long-term consequences? Declining demand for the US dollar will suffocate the US bond market and tighten capital flows to Wall Street. China is gradually creating its own financial system, preparing to replace the dollar's central role. Can you imagine a future where the renminbi becomes the global financial hub? And how will the US react when the dollar's king status starts to shake violently?
As you know, Mercedes and BMW and Volkswagen and many others, and we were restricted from restricted from selling cars into the European Union, which is not nice. And I just said it's time that we play the game the way I know how to play the game.
Cars. It's one of Germany's most important manufacturing sectors and is now under new U.S. tariffs. We're joined by Hildegard Müller, president of the German Association of the Automotive Industry. Hildegard, thank you for joining us, but start us off. Automotive tariffs from the United States are now underway. How significant are these fees?
I mean, these fees are overall a disaster for the free trade and for every market, not only for the European or Asian markets, but also for the American market.
Did you know? Profits for German cars like Mercedes and BMW dropped over 40% in Q1 2025 due to a 50% US tariff. So, how does this affect you? US tariffs and German automakers' response. Can you imagine? The US slapped a massive 50% import tariff on all cars from the European Union. This blow targets giants like Mercedes, BMW, Volkswagen, Audi, and Porsche. This isn't just a tax number, it's a seismic shock shaking the free trade system. German automakers' profits plunged over 40% year over year. mainly due to disastrous sales drops in China, a critical market, combined with escalating trade tensions. But instead of giving up, these companies are fighting back. They're not pulling out of the US, the world's largest luxury car market, but temporarily pausing or limiting exports and restructuring supply chains. They're striving to keep prices stable, postponing hikes to maintain customer loyalty. Do you see how under immense pressure, German automakers are determined to hold their market share? Is maintaining prices and loyalty enough to weather this crisis? Production shifts and market impact. The massive US tariff pressure forced German automakers to immediately change strategies. BMW ramped up production at its South Carolina plant to avoid tariffs, while Mercedes-Benz cut budgets and Volvo reduced staff and postponed new product launches. It's not an easy situation. So, how will American consumers be affected? Imagine luxury cars becoming increasingly scarce in inventory, longer wait times, and prices possibly rising by up to $10,000. Dealerships are cutting advertising, halting hiring, and preparing for a tough sales season ahead. Moreover, experts warn that the German economy could shrink by nearly 2% of GDP, the most severe decline since the 2008 crisis. This would also weaken the Eurozone and other key economic alliances, especially amid growing geopolitical tensions. What do you think about these major changes? How will the auto industry operate in the near future? EU's response and the risk of a full-scale trade war. Europe cannot stand idly by while the US imposes such heavy tariffs. The EU is preparing a massive retaliation package worth 95 billion euros, targeting US products like bourbon, motorcycles, aircraft, machinery, and cars. A strong response to Washington's actions, but it doesn't stop there. The EU has formally filed a complaint against the US at the World Trade Organization, citing violations of international trade law. This shows the dispute has moved beyond negotiations into the legal arena. Negotiations are set to conclude by July 2025. Without an agreement, the risk of a full-scale trade war is very high, threatening severe damage to both sides and the global economy. Do you think the EU will stand firm, or is there a way to prevent a large-scale trade war? Current situation and outlook. German automakers are closely monitoring and adapting to market conditions. They face a tough choice: shift production to the US and bear higher costs, or risk losing the crucial American market. The impact of these decisions extends beyond factories, dealerships, and workers. It affects consumers worldwide. What do you think will happen next for the German auto industry and the US market?
Donald Trump has told a rally at a US steel plant in Pennsylvania that he intends to double US steel import tariffs to 50%. The president said the increase would offer the country's steel industry more security and vowed to stop any countries getting around the new rate.
We are going to be imposing a 25% increase. We're going to bring it from 25% to 50%, the tariffs on steel into the United States of America, which will even further secure the steel industry in the United States. Nobody's going to get around that.
Steel tariffs rise 50%. 5 U.S. giants halt lines, raise prices, cut production. Ready to discover why? Steel tariff policy and the unstable context. Did you know? The U.S. steel import tariff has surged to 50% in a short time. This major decision aims to protect the domestic steel industry from massive pressure by cheap imports. But has everything gone as planned? In reality, instead of stabilizing steel development, this tariff policy has thrown many big companies into turmoil, facing unprecedented difficulties. Not stopping there, the government has delayed imposing a 50% tariff on goods from the European Union due to stalled trade talks with no progress in sight. So, what do you think when a policy meant to be a shield protecting American industry turns into a double-edged sword? The instability and uncertainty in tariffs have created an extremely difficult environment for businesses. They can't plan production or predict how raw material costs will fluctuate in the near future. Many companies have started turning to more stable markets like Mexico, Vietnam, or Thailand to avoid risks and maintain operations. Tariffs are no longer just numbers. They are major barriers that make every production and investment plan tangled and uncertain. How long do you think this policy can last before its negative effects spread even further? Direct impact on major companies and consumers. Let's take a look at 5 American giants facing heavy pressure from tariffs. Walmart, the leading retailer, openly admits tariffs are squeezing profits. They've raised prices on everything, from essentials to electronics, while cutting thousands of orders and suspending contracts with some suppliers. General Motors and Ford, the automotive giants, withdrew financial forecasts due to unpredictable raw material costs. Ford halted some production lines. GM cut investment plans. Harley-Davidson, the iconic motorcycle maker, moved production to Thailand to avoid import tariffs as high as 60% in key markets. Caterpillar, a construction machinery leader, suffered a $350 million loss in one quarter due solely to tariffs. Their CEO is considering downsizing domestic production to survive. Nike raised prices by $2 to $10 per pair of shoes due to import tariffs from Vietnam, forcing cuts in promotional programs. With prices rising and products shrinking, how do you think American consumers will react going forward? Widespread impact on labor market and supply chains. Tariffs not only challenge businesses, but also directly affect workers and the national supply chain. Many factories have been forced to shut down or cut staff. Contracts are canceled, transportation activities shrink, supply chains break down, and prices keep rising. Do you know that those hardest hit are factory workers and small businesses who rely entirely on stable supply chains to make a living? A policy intended to protect the economy, but is it unintentionally sacrificing essential opportunities and rights of the labor market and consumers? Economic overview and an open question about the future. Tariffs are seen as a political weapon to boost domestic production, but what's the reality? They are causing deep and widespread damage to the U.S. economy. Many big companies are pulling out, not by choice, but to protect themselves from unpredictable policy shifts. Once factories and investments move abroad, is it easy for them to return? The answer is almost never. So, do you think this is the price America must pay for protectionist policies?
I've always worked to be very competitive from a pricing perspective and leveraging our strong portfolio. I'm very proud in this first quarter, we grew 2 points of market share. So we're going to continue to leverage our strong products across Cadillac, GMC, Buick, and Chevrolet. And we will be competitive in the marketplace. But right now, as we look going forward, we think the pricing environment is going to be much where it is right now.
General Motors is facing losses of up to $5 billion. And more than 50,000 jobs in the U.S. auto industry are at risk. But are tariffs really the main culprit? Tariffs, a double-edged sword cutting deep into GM's costs. Tariffs of 25% slapped on imported auto parts were supposed to be a win for American jobs. Instead, GM is staring down a multi-billion-dollar loss. Take the Chevy Silverado, assembled on U.S. soil, yet burdened with an extra $3,200 to $3,600 in costs. These added costs force GM to raise prices, putting pressure on consumers already juggling budgets. This ripple effect forces GM to rethink production, pricing, and competitiveness, all under the shadow of these hefty tariffs. Production disruptions, layoffs tied more to demand than tariffs. You might think tariffs alone are firing workers, but the reality is more nuanced. GM's factories, Factory Zero in Detroit, Cami Assembly in Canada, are slowing output, mainly because people aren't buying as many vehicles, especially electric ones. Despite nearly doubling EV sales to 31,000 units in early 2025, GM missed the 100,000 unit break-even target. This shortfall causes temporary layoffs. About 200 workers at Factory Zero, over 400 at Adient's Tennessee plant. While tariffs add pressure, it's the interplay of soft demand and company restructuring that's driving production changes. So it's not all tariff fault. It's a cocktail of market realities shaking the industry. Electric vehicles, green dreams collide with rising costs. The electric revolution promises a cleaner future, but the road is bumpy. Tariffs on key battery materials like lithium and cobalt have boosted Ultium battery costs by 10 to 15%. That's roughly an extra $1,200 per EV. Combine this with shrinking government tax credits, and suddenly GM's EVs get pricier and less competitive. The company's goal of selling 100,000 EVs to break even now looks distant, with projections closer to 65,000. This means GM is racing against rising production costs and softening incentives. workers and unions, caught in a tug of war. The tariffs have stirred up tension among the workforce. Some workers rally behind protectionism, hoping tariffs shield their jobs. Others worry that rising costs and unpredictable hours mean less take-home pay. The United Auto Workers Union calls for defending American labor, but unions in Canada and elsewhere warn about fractured solidarity. This division isn't just about dollars, it's about trust, morale, and future bargaining power. Facing unstable schedules and shrinking paychecks, workers are caught between hope and frustration. How they navigate this struggle will shape labor negotiations and maybe the very future of manufacturing in North America.